Hello everyone, welcome back to our channel Trading Critique. Today, we're gonna chat about something every trader encounters, slippage. It's not exactly the fun part of Forex, but understanding it can save you frustration and keep your trades on track. So, grab a coffee, because we're diving into the world of Forex slippage, what it is, why it happens, and how to, somewhat, tame this beast. What is Forex slippage? Imagine this. You see a hot deal on EUR, USD, hit that buy button at 1.2000, but your order fills at 1.2003. That difference, my friend, is slippage. In simpler terms, slippage is the gap between the price you request for a trade and the price it actually gets executed at. It's like attempting to buy a candy bar for $1, only for the cashier to inform you, sorry, the price just increased to $1.02. Not the best situation, right? Why does slippage happen? The Forex market is a fast-moving beast. Prices can change in milliseconds, especially during high volatility or news events. Here are the main culprits behind that uninvited slippage guest. Market volatility. Picture a roller coaster. When the market's zooming up and down, it can be tough for your broker to fill your order at the exact price you requested. By the time your order reaches the market, the price might have already shifted. Low liquidity. Liquidity refers to how easily you can buy or sell a currency pair. Imagine a currency pair like EUR, USD is a bustling marketplace. Less common pairs might be like a small corner store. If there aren't enough buyers or sellers, low liquidity, filling your order at your desired price might be tricky, leading to slippage. Order type. There are two main order types, market orders and limit orders. Market orders aim to get your trade filled as soon as possible, no matter the price, within a certain range. This makes them more prone to slippage, especially during volatility. Limit orders, on the other hand, specify the exact price you want to buy or sell at. While they can help avoid slippage, they might not get filled at all if the market doesn't reach your desired price. The two faces of slippage. Now, slippage isn't always a villain. It can sometimes work in your favor. Imagine you want to sell USD, JPY because you think it's going down. You place a market order, expecting a bad fill, but the price unexpectedly drops even further. Boom! Positive slippage. You sold at a better price than anticipated. However, negative slippage is the more common foe. You think you're getting a steal, but the price jumps before your order fills, leaving you with a higher buying price or a lower selling price than expected. Not cool. How to mitigate slippage? Since slippage is a fact of Forex life, we can't eliminate it entirely. But there are ways to minimize its impact. Use limit orders. As mentioned before, limit orders can help you avoid unwanted price surprises. Just remember, your order might not get filled at all if the market doesn't reach your desired price. Trade during peak hours. Liquidity tends to be higher during peak trading hours, like the London or New York sessions. This reduces the chance of significant slippage. Choose liquid currency pairs. Sticking to major pairs like EUR, USD or GBP, USD generally offers better liquidity, which can minimize slippage. Be realistic with order sizes. Don't try to swallow the entire market with a giant order. Large orders are more likely to experience slippage, especially in less liquid pairs. Break down your trades into smaller chunks for smoother execution. Find a reputable broker. A good broker prioritizes fast trade execution and minimizes requotes when they ask you to confirm a new price due to slippage. Remember, slippage is a natural part of Forex trading. By understanding its causes and taking steps to manage it, you can be a more informed and prepared trader. So, there you have it. Forex fam. Slippage, not the most exciting topic, but crucial knowledge for navigating the Forex market. Do you have any experiences with slippage? Share your thoughts and tips in the comments below. Don't forget to like and subscribe to Trading Critique for more Forex insights, and until next time, happy trading.